Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for September 14th, 2021. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist, Dean Croak, who is our Principal Industry Analyst, and we have a very special guest this week. We have Todd Amon from American Truck Business Services. Welcome, everyone.
Good morning. Hey, Ken.
So, Todd, you're coming to us from where this week?
I'm in Denver.
Nice, the Denver connection, right? We've talked on the show before. We did a live show. It was a comedy of errors when we were in Denver.
That was not the most suave technical production.
Right. So
yeah,
we used to be able to joke because it was because of legal marijuana. Things always get screwed up here, but that's not, that's spread throughout the country, so you can't blame it on that anymore.
It gets screwed up. You just don't care as much. So, hey, before we dig into the show, can you tell us a little bit about ATBS and kind of the cool stuff you're doing over there?
Yeah, Ken, I'd be happy to, and thanks for having me on, you guys. It's a pleasure to be here this morning. Our business is about working with independent contractors, and a lot of people think of us as the accounting and tax company in Colorado, because at the end of the day, that's really what our business is about, is getting tax returns done for independent contractors. We do about 15 to 20,000 tax returns a year, but the really fun part of that is we get to go through a lot of data and understand their business. We do P&Ls every single month for about 20,000 drivers. And so with that, we analyze what's going on with their business. And probably the funnest part of our business is we consult with those drivers on how to make more money, where they're doing better than their peers and where they're not doing as well as their peers. And we talk about, where to improve your business.
Cool. Yeah, we actually had a connection. We were talking pre-show. I did some work when I was at FedEx. We did some work with ATBS, and it was a small world that we were able to kind of tie together a quick connection already this morning.
That's true.
All right, so Todd's going to join us for the Ask IQ question later in the show. There's obviously a lot to talk about as it pertains to small fleet owners and independent owner operators. But before we get to all that, we do have our typical show. As you all know, we took last week off. Dean is chock full of lobster. He's going to not get his cholesterol tested for the next couple of weeks to let that sort of clear out of his system. But we're happy to be back talking about the freight market. So with that, I'm going to move us to the key points for the week, because there's a ton of stuff going on to catch our viewers up on. So some really interesting things happening. We're seeing load to truck ratios come down and volumes come down considerably across dry van and reefer, but spot rates continue to just be on a tear. And we're going to talk a little bit more about why that is. Well, Dean is anyway. So dry vans, that they've been bouncing off this 250 number for quite a while, and then they come back down and then go back up. They're really seem to be challenging that in a more robust way on the dry van side, which will be very interesting as we head into peak. All you have to do if you're in transportation is to go on LinkedIn or another sort of social media site and see the drone footage or people going to Catalina Island of all the boats offshore at anchor in LA Long Beach. It's wild. We're sitting at 57, which is just crushing records. And again, Dean's going to cover why that's important. And then last but not least, surprise tropical storm / hurricane Nicholas is currently hitting Texas. There's the Atlantic Basin is rather active. There's a pretty scary looking one. They call it a lowrider coming out of Africa right now that some of the models are showing potential that could potentially have Florida in its sights over the next week and a half. So something to keep an eye on, especially during this time of year. We're well ahead of schedule as it pertains to named storms. So something to keep an eye on. With that, I'll turn it over to Dean to walk us through the market update.
Yeah, thanks, Ken. Great to be back. Last week I spent about 2,500 miles driving my truck and having a close look at how the lobster production works. It's PEI lobster season. A lot of that volume moves down to the New York and Boston market. So it was fascinating to see lobsters get caught in the morning and then within 24 hours be in Hunts Point, New York, into the seafood markets, in particular all around New England. Just an incredibly efficient supply chain. Anyway, looking at our market, lots has happened since we had our last show, starting off with our load board activity in the dry van sector. The last week we saw volumes drop. No surprise here. Volumes are down about 20%, short work week post Labor Day. So nothing unusual from a seasonal perspective. Carriers took time off, so we saw fewer equipment posts. What that did to the load to truck ratio was it dropped it down to 6.18 from 7.02. In terms of loads moved within our system on the top 100 lanes, loads moved in terms of volume increased on only 10 lanes compared to the week prior, but dropped on 88. Again, no surprise there. It's a slower week, a shorter 4-day week. Having a look at the load board activity in the refrigerated sector, volumes also dropped by about 21% last week. No change in equipment posts, so the load to truck ratio dropped to 12.59 from 16.02. And in the flatbed load to truck ratio, look this week, 2 weeks of increasing load volumes. In the prior 2 weeks, last week, the flatbed market reverted to its longer term downward trend. Volumes are down about 20% also. Equipment posts dropped by about 10%. So the combined effect on the load to truck ratio was it dropped to 42.55 from 47.69 the week prior. Shifting to our market condition index, lots to cover this week. In the dry van sector, I've been watching the Philadelphia market, a little bit of a look at this market this week in the dry van and reefer sector. Lots more imports are coming in. Shippers are moving a lot of their import volumes to less congested ports and smaller ones along the East Coast. Philadelphia is one of those. Volumes are up about 28% year over year in August on the import container side. Spot rates have been driving up for about 4 weeks in a row now. They were up 16 cents since mid-August. Outbound Philadelphia, they're averaging about $2.55 a mile now, excluding fuel. Philadelphia to Atlanta hit $2.40 last week, up 24 cents a mile over the prior week. And on the 460-mile haul to Columbus out of Philly, spot rates averaged $3.02 last week. That's $1.35 a mile higher than the same week last year. That's Philadelphia to Columbus dry van. A lot of attention this week in the port complex, San Pedro Port Complex. There were 6 new records were broken yesterday, 57 large container ships at anchor. That surpasses the record of 40 set back in February, so peak shipping season is causing lots of congestion out there. Volumes this week in terms of the number of containers that will be put on the dock are about 53% higher this week than the same week last year. Wait times out to 8.5 days. We see a lot of tight correlation between TEU volume and spot rates and load volumes. Spot rates out of Los Angeles are up to $3.18 a mile, excluding fuel. That's up 10 cents a mile in the last 3 weeks. And on the benchmark e-commerce lane that I like to watch from Los Angeles to Phoenix, where there's a lot of warehouses, spot rates are currently averaging $4.26 a mile, excluding fuel. That's 42 cents a mile higher than the same week last year. And wrapping up the market condition index, look with the refrigerated market. Restaurant bookings are generally down as the Delta variant keeps customers away. Restaurants are finding it hard to find people. They've got reduced hours. Lots of things going on there that we were certainly not planning for. So that'll dampen volumes of truckload produce. Since the July 4 peak in produce shipping volumes, load counts are down about 26% last week. That's the equivalent of 15,000 fewer loads of produce compared to the week right before July 4. In Philadelphia, again, a big port market for imported produce. Reefer rates are approaching $3 a mile, ending last week at $2.97, so they'll bump up at $3 this week. They're up 19 cents a mile over the last 4 weeks in the Philadelphia market outbound. Philadelphia to Dallas, 1,500-mile haul, rates are up 76 cents a mile since June to an average of $2.49. And a quick look out west, reefer spot rates on the 270-mile haul from Los Angeles to Las Vegas have broken through the $6 per mile mark. Last week, they averaged $6.17. And for carriers that are doing round-trip work, looking for a round trip every day, that's the equivalent of $3.08 per mile for every mile they'll travel, including the deadhead back to Los Angeles. And in flatbed, lots of impact we can see from the flood ravaged Gulf Coast region. Loads into the Gulf Coast, the flatbed sector attracted a premium last week. Inbound volumes were up 31% last week and up 78% over the last month. And that's just into New Orleans alone. Spot rates from Jacksonville to New Orleans averaging $2.72. That's 60 cents a mile higher than the August average. and $1.16 a mile higher than the same week in 2020. Higher volume lanes out of Texas to New Orleans spot rates surged last week. Houston to New Orleans up by $1.22 a mile over August to reach $4.04 last week. So that's Houston to New Orleans at $4.04 excluding fuel. That's about $1.58 higher than the same week last year. And on the West Coast, spot rates broke through the $4 per mile mark for loads from Reno to Seattle, averaging $4.07 last week. That's $1.10 per mile higher than the same week in 2020. So wrapping up our freight market update with our year-over-year look at spot rates. In the dry van sector, after being relatively flat for the last months, dry van spot rates broke through the 250-mile barrier last week. That was for the first time we've seen that this year. Average rates were up 5 cents a mile last week to $2.51 excluding fuel. That's despite a 20% week-over-week decrease in load volumes on the short post-Labor Day week. Compared to the same week last year, dry van rates are 35 cents a mile higher this year. Having a look at refrigerated now, very similar to dry van, rates also increased up by 3 cents a mile last week to an average of $2.84 excluding fuel. Compared to last year, 48 cents a mile higher this time around. And wrapping up with flatbed, after spot rates were decreasing steadily for most of July and August, they've now been inching up for the last 3 weeks. For most of July and August, they were sort of dropping by a penny per mile each week. They're now doing the same thing in the other direction. They're up 1 cent a mile last week. National average flatbed rates are sitting about $2.65 a mile excluding fuel. That's 48 cents a mile higher than the same week last year. And compared to the flatbed rate rally in 2018 that we all remember, rates are about 48 cents a mile higher also. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report. And with that, I'll hand it over to Ned for the short-term forecast.
Hi, everybody. Just a quick note before we go into the details of the forecast. We love to have listener questions, viewer questions. So if you have any questions, comments, concerns, or burns, please drop them into the chat in whichever service you're watching us on, and we'll get to them as time permits. So with that, we're going to be moving on to the short-term forecasts. So we're going to be beginning with dry van. In blue, you can see the market rates observed by DAT, and then off to the right, you can see the various forecasts that we have. In green is our flagship ratecast forecast. In red is the short-term forecast, and in gold and silver are the two blended forecasts, which are mixtures of the two in different amounts and in different ways. You can see that the ratecast forecast is expecting for the next 2 weeks rates to remain at this level and then move up as we're heading into the later part of September. Rates moving up as we head into the later part of September seems to be a pretty common theme. So keep that in mind as we move through the rest of the forecast. Short term is expecting just up and to the right. Here there's broad agreement that the rates are going to be moving up. So given that and then the recent very sharp increase in rates, I would definitely watch out for dry van rates to continue to be moving upwards. Moving on to reefer. The reefer charts are a little bit muckier. Once again, you can see in blue the market rates observed by DAT, and then off to the right are varying forecast models. It's kind of a mess, lots of forecasts, but there are all broad agreement that rates remaining at about the same level. Red is our short-term model, green is our ratecast model, and gold and silver are the two blended forecasts. They're all expecting, as I said before, rates to remain at about this level with maybe a little bit of upside into the short-term model as we head into the early part of October. Finally, moving into the flatbed sector, here we have pretty substantial model divergence for a given value of substantial. Once again, blue is the market rates observed by DAT. Green is our flagship ratecast model, which is expecting a rise in rates as we head into the later part of September, early part of October, and then a drop as we move further into October. The short-term model is expecting things to remain steady as she goes, and the two blended forecasts are citing more, with the short-term model expecting rates to remain more or less flat through the next month. With that, we have covered all of our forecasts, and we're on to the Ask IQ question of the week. What's driving the dramatic increase in the number of owner-operators over the last 18 months?
Okay. All right. So maybe I could get started with a sort of a segue into Todd's section. We just pulled down the latest data from the FMCSA, Todd, that shows that the industry's added a substantial amount of capacity in the last week. So as of August, the industry's added, this is year-over-year data, added 233,000 power units to the industry. So that's an increase in capacity of about 5.7%. But what's striking, and this has been a trend that's been evident since PPP loans ended last July, and also spot rates started to take off, was this incredible uptick in owner-operators. And I think you've got a good reason for why a lot of people have started running on their own authority. But the data shows that about a third of all of the capacity that's been added in the last year have come from owner-operators with one truck. When you broaden that out, about 75% of all the capacity added in the last year is in the in the 0 to 40 trucks, so 1 to 40 truck, sort of the small fleet sector. So most of the capacities come from the smaller sector, but I think the surprising stat, and this is probably your core customer base or owner operators, Todd, most of the capacity, in fact, by a factor about 3 to 1 compared to large fleets, have come from the smaller owner-operator fleet. So with that, we'll throw it over to you to talk more about what you're seeing in the freight market, but maybe help us understand a little bit about what's driving this incredible surge in capacity in the owner-operator sector.
Sure, Dean. You guys, I think, look at it from a little bit of a different angle than us, which is awesome. The kind of, rate side and what's driving the market. And I guess we see the end result of that in net income and what's happening in the business world of owner operators. And we've tracked, gosh, for about 10 years. We just look at the break even, where does it make sense for me to make the most money? And our business in the early days started out, and still predominantly today, is with partnerships. And so we get a lot of our drivers through the large fleets. You could name any that have 1,000 or more drivers: Landstar, JB Hunt, Schneider, Swift, Knight, on and on. And so we pay attention to those numbers, but we also have a large number of drivers that are independent. We call them Lone Rangers out there doing this on their own. We consider the break-even point from, should I operate, kind of, our world of contract is a little bit different than trucking thinks of contract, but a contract, for us is I'm operating for a motor carrier, which makes my life easy. They book my freight, they provide my trailer typically, I get my insurance discounts. If I'm going to leave that kind of umbrella of easier to do business and go out and do this on my own, it costs me about $50,000 or about 50 cents a mile. And so, for a long time, we were below that break even or near that break even. 2018, we spiked above it. 2019, we went below it. And then middle of last year, post COVID, we went way above it. And we've been $1 above that break even, dollar per mile. So really what that means is I can operate under a motor carrier for around $1.50 to $1.60 per mile. And as you guys just ran through really well, I can make anywhere from $2.50 a mile or higher operating in the spot market. So what that means to me, bottom line, is our average, we just finished our first half of the year benchmarks, and our average client made $70,000 of net income annualized over the last 12 months, which is a record. That's the highest they've ever made. But if I'm out there doing this in the spot market right now, I'm going to make about $120,000 on average. So that's why you've seen a huge amount of capacity created in that one truck driver, because it's easy to do right now. They can go out, this isn't saying anything bad, but any dummy can get a truck and a trailer and run the spot market and make money right now. It's that easy, right? And so until we get closer to that break even, back down around 60 cents a mile, you're going to continue to see people operate in that spot market.
I have a quick question for you. When you were talking about in prior years when the sort of average customer was below break even, is it an issue that they need to do a better job of controlling costs, or is it really just more on the income side if you're trying to operate in an unfavorable market as that Lone Ranger?
It's a bit of both. At the end of the day, you can control costs when you're an owner operator. Fuel is your number one cost, and you just by managing, you can save $10,000 to $15,000 a year. So that's significant. The rest, my truck is a fixed cost. A lot of my insurances are fixed costs, so I can't really manage those. Maintenance, I can manage a little bit. So a lot of it is rate driven. When we get below that break even, it is rate driven. The hardest part about when we get to that break even, everybody wants to flock from the spot market back into running for a carrier. And that's the exact time the carrier doesn't need the capacity because the freight market is dried up a bit, right? So you kind of got this conundrum of, hey, I'm going to go out and make all this money when things are hot, but then when I want to go run for motor carrier that has that 3-year contract that's long term with the shipper that pays a decent rate but not a great rate, they don't need me anymore. So it's that's the way the market fluctuates.
Todd, just on the subject of fuel, you and I co-authored a piece a few months ago, and I think we titled it "Is Now a Good Time to Buy a Truck?" because that was sort of the most common question with spot rates so high. Everybody was interested in that. Is it a good time to get into dry van or reefer? One of the things that I've always focused on, even when I was hauling freight, was fuel as a percentage of revenue. And my long-term target, and admittedly a lot of my miles were in Australia, but the numbers kind of work out pretty much the same. I always focused on whatever fuel was about 25% of my trip revenue, and that was a number I could really do quickly in my head, sitting behind the steering wheel when I was looking at loads. If I kept fuel at 25% of revenue, long-term I was profitable, and that's drawing a wage and paying all my bills. How do you look at that in your business, and what sort of numbers do you keep your carriers focused on?
Dean, that's a really good target, 25% of your revenue for fuel. Of course, it depends on what you're doing. If you're hauling light loads in the dry van business, you should be significantly lower than that. If you're doing heavy haul, short length of hauls, you're going to be a lot higher than that. But, for me, the reason I love owner operators is the fuel's changed a lot, right? Over the last 18 months, we've gone from 3.25 down to below 250. Now we're back over $3. And when revenue is high enough, people don't care. They don't pay attention. They just want to not speed. They want to drive as fast as they can to the next load. But at the end of the day, when things kind of flatten out and my revenue is kind of static, truly, I can affect my bottom line by 20% by managing my fuel costs. In times like now, though, people don't care. There's enough money that they don't care about fuel costs.
Right.
To the point that you made earlier about wanting to, like, when the market turns, people flocking back to what you're calling the contract market, where the leased on carriers, is there obviously you can't time the market, but is there a good sign for when you should start considering to get ahead of the pack?
It's a really, really good question. And honestly, gosh, we kind of do our tour of sharing our data with a lot of our partner carriers in the last 3 weeks. Been with a lot of those big carriers, and they're like, we just can't find these guys. Where are these guys with their own trucks? We're trying to get them, and when are they going to come to us? And I guess I've never really thought about it because we haven't seen such ups and downs in the market, right? Like $1 premium just hasn't happened before. In 2018, it was more like maybe 65 or 70 cent premium. So I guess what my gut would tell me is we haven't peaked yet. We're still hovering. We've been that buck for over a year. When we get down around 70 cents a mile, I don't think anybody's predicting a sharp drop off. So when we peak and we start coming back down, I would give it a few months. And if it feels like the market's softening, that's when I would start looking to maybe find a little more stable long-term revenue source than playing the spot market.
Todd, one of the things that we've sort of been harping on here is that, or at least one of the things that we've been holding to be relatively true, is that when all of these Class 8 truck orders that have been ordered, they've been delayed due to the chip shortage, other part shortages, that's going to be a major driver of the inflection point of rates. I guess, one, do you agree with that theory? And two, when do you see these trucks getting delivered?
Boy, another great question. I think that our industry continues to grapple with. We do a ton with Diamler. They're a really good partner of ours. Talk to them on a weekly basis. And, so the difference that I hear, and I am lucky enough to talk to CEOs of the really large truck lines. So the difference today is not just trucks, right? We have all these things that are lined up to limit capacity. We can't find drivers. Trucks are backed up on production. There's no end in sight for that. It's going to happen, but at some point we're going to bring trucks in, but it's still, we don't see it. The used trucks are at record highs. We have an inventory. We haven't rebuilt inventories in America. So when you put all those things together, it feels like, to me, even when the trucks come back, will we be able to find the drivers? We're in a robust economy. We can't find enough people to even work in restaurants, so we'll pay an equal wage to go work in a restaurant today than almost driving a truck. So it's almost like coming out of the Great Recession. It was like 2012, 2013 before we stopped all the government incentives to stay home. So a lot of stuff's got to get cleared up. And I don't know. we've been in a boom for almost 18 months in trucking. We never have a boom for more than 18 months, but I'm hearing from a lot of the folks we're talking to, they expect this to last through 2022.
Mm-hmm.
Yeah, I mean, Honda and Toyota both just curtailed, if not flat out shut out production for certain model lines, right? So I don't know that these trucks are going to hit the road in mass anytime soon. And without that, I don't really see. I mean, well, you can't really predict for like global economic collapse. Sure, that could happen. It'll bring rates down. I don't know that anyone. You can't predict it, and I don't think anyone's clamoring for that to happen. Where I sit, the single biggest thing that's going to drive rates back down will be the influx of capacity in the market. And I just don't. Talking with carriers, talking with shippers, and hearing what you've heard from OEMs, it just doesn't sound like it's going to happen in the next 2 quarters, most likely.
In the past, that's really what's happened. We overtruck the industry, even if the economy is good, and it hurts from a rate perspective. And it's just so when you think about the truck issue we've got, most big fleets have extended their trade cycle, right? They're running trucks a year past when they expected to. And so even when the new trucks come in, the used trucks that get taken out are going to be worn out and tired, and we can't get parts. And so that used truck market oftentimes is what creates that secondary boom, because it's now cheap for me to go buy an owner operator truck. And yeah, there's just, I don't know. I'm a realist, not an optimist, and not a pessimist. I'm a realist. And there's a lot of things lined up for this to be in favor of the truckers for a time to come, for sure.
For sure. Yeah, it's going to be interesting. We're in uncharted waters. I mean, the questions we're starting to think about are like, what might never go back? So like, what fundamental shifts have happened that where you may never see $1.80 a mile again in the spot market? You know what I mean? Or you may never see $1.60 a mile on the spot market. Let's not forget. Yeah. I don't remember where it bottomed. Dean would know better, but like when they were protesting in front of the White House, spot rates at a national long haul level were $1.25, $1.30.
Early May.
Yeah, May 10th or whatever that protest was. So
the cost of doing business has gone up a lot, right? I mean, everything
insurance
from insurance to fuel to trucks. So you're right. I mean, the break even fall freight is up a lot.
Yeah, that's something we grappled with when I was in the industry, right? The cost of doing business has gone up kind of rather linearly over time. I mean, you see like these chunks, right? ELDs kind of put a hedge in place that is never going to be taken away. And you're seeing some of these shifts in insurance, and the Drug and Alcohol Clearinghouse might, but generally speaking, it's more expensive to operate a truck next year than this year. Just generally, right? Tires don't get any less expensive. Maintenance, the people working on the diesel mechanics they're getting wage increases year over year, so it all goes up. I had one last question before we get to the broad questions. What do you think about, I mean, there's been some healthy debate, some surprising hot takes about the driver pay increases we've been seeing from the large asset fleets. Where do you come down on driver pay increases and what you've seen so far and what's probably going to happen over the next 18 months?
I'm a fan of driver pay increases. Obviously, I think they're underpaid for what they do. And at the end of the day, truck drivers work harder than just about anybody that I know. I think there's more to come, simply because we can have the debate about transitory inflation versus real inflation, but I know the cost of my hamburgers and my lunch out and my groceries and dang near everything that I consume has gone up. It has for the truck driver too, right? And my employees in Denver, we're in a little bit of an abnormal labor market, but our wage costs are going up. So wage costs are going to keep going up for truck drivers. They have no choice, because inflation is here, whether we like it or not. Inflation is here in a significant way, which means wages have to go up for people to continue to live.
Yeah, I mean, like I said, there's been some surprisingly hot takes. I mean, ATA came out and said, of course, they're in favor of pay increases, but they're worried that those things are hard to, like, you can't put the toothpaste back in the tube, and carriers could, like the bigger carriers that are paying the wages, could fall on hard times. But I'm with you. I think, look, it's Truck Driver Appreciation Week, I believe. That's this week, right?
Yep, correct.
Yeah, so I think now's it feels like the last 18 months have been Truck Driver Appreciation year and a half, or at least it should be, right?
Yeah. Right.
They deserve it.
Yeah, for sure. They've been frontline essential workers since the start of this thing, from delivering the 10 years worth of toilet paper in 1 month all the way to like getting Halloween and Christmas decorations, rushing them from the port to the shelves to make the holiday this year. They're definitely underappreciated. All right, we have a bunch of questions rolling in. What do you think, Ned?
We'll get through as many as we can. Eamon asks, does DAT accept international truck drivers? If you have an authority, we will let you on the load board. But we're not in the business of offering you loads. That's really to the brokers that you're interacting with. Comments on that?
You're right.
No.
I mean, Dean's an international truck driver, technically. I think it all depends, right? If you have authority to run in the United States, then I think I agree with Ned. Yep. I don't know. Beyond that.
Yep. We have a lot of, at DAT, we do have a lot of services for non-native English speakers. We have a lot of Spanish staff for people who are primarily Spanish speakers to help out. I'm not sure about other languages. I know that there's a lot of Sikh truck drivers. I'm not sure how the Punjabi is among the DAT personnel, but we're happy to help in whatever ways we can.
Correct.
Yep. All right. Next up, ROI asks, I'm in Europe and I'm getting 1.4 euro a kilometer, 268 a mile, and it makes me happy. Glad to hear it.
Yeah, that's a cool data point. I'm going to share that with our team in the Slack channel today. That's pretty darn close to what the national average is in the United States adjusted.
Yeah.
Right now, when I was in the industry, we were looking for like a European benchmark, and like it sounds super obvious, right? But going from Germany to France isn't the same as going from Ohio to Indiana or Illinois. It's just not, right? These benchmarks don't make sense in that context. So that's really cool. Thanks for sharing that.
Yeah. Bradley Holbert says, do you track and go back and determine the accuracy of your forecast models? If so, what level of accuracy do you typically see? We certainly do, specifically for the Ratecast model. Thank you. We're currently above 95% accuracy. Is it 14 days out, Ken, in the Ratecast model?
Yeah, I think we're at like 97.5% 14 days. Our 95% threshold is extended almost to the entire 30-day forecast horizon.
Yeah. So short-term model does not get tracked because the short-term model is something that I cooked up in my basement to help give sort of a minority report. But if people are interested, I can go back and score the short-term model and see how well it performed over time.
So first of all, I don't know how much Ned paid Brad to bring this up, but I'm glad that you did. We don't talk about it too much because, I mean, Ned, he'll just become insufferable. But in all seriousness, the models have been we've added MCI into Ratecast as well, which especially in the short-term model has just made it, 94% of lanes we saw a market improvement, Ned?
Yeah.
This isn't bragging. I'm just kind of laying out the facts. You guys asked the question. But yeah, we've been, even in the long-term models, frankly, 6, 8, 9 months out, we've been trending above 90%, which is outstanding when you consider how hard it is to predict spot rates more than a couple months out. So, kudos to the team on that. And what Ned said about the short-term model that we show in this show is meant to be alarmist, up or down. It's meant to you get the morning paper and you change everything about your day as a result of it, kind of thing. FYI, that's why we don't really measure accuracy on that one.
But I can absolutely, if people are interested, I can do a back score of the short-term model to see how well it performed. Ken, I would also thank you for not saying more insufferable rather than just insufferable.
I bit my tongue.
Douglas Rose says, Ned, where we can find the details of the differences between your forecast models. Currently, we don't publish the short-term model, so I can't go into too much of a detail about that, but that's the algorithms are different. The short-term model has a much shorter historical time horizon, so it doesn't have like the deep historical weighting that the Ratecast model does. That might be a show in and of itself to talk about like how we build models. I don't know how much of an interest there would be. Comments? I don't know. I feel like I'm getting a lot of these questions.
So for this show, what we're trying to show you is kind of if you be a little bit more selective in what history you choose, the future will look different. So if you're more biased towards like, my business is a broad operation, I don't want to be super reactive to short-term changes in the market. That's why that's the product. Right? You log into RateView, you log into Ratecast or the IQ Workbench. What you see is Ratecast, and you get the high-low average, which is a completely different ball of wax. Right? Those are high-low estimates based on the Ratecast core forecasting algorithm. What you see in this show is essentially like an analytical tool to snip out a bunch of history to purposely overreact to short-term reverberations to show like what a short-term projection of the current market climate, right? It's like forecasting today's weather forecast ahead for the next year versus looking at like climatological long-term forecasts.
Yeah, no, the short-term model is basically taking the trends of the last short-term period and projecting them forward.
Yep.
It's saying like, if conditions continue going the way they're going, this is where we expect. And so it does naturally behave kind of oddly. It also
so you would never want to do an RFP with the short-term forecast, right?
Please don't. Please don't. Julio Cardenas asks, how do you have accurate rates based on market changes? Sometimes driver asks for a rate and the DAT has a different number. That is an unfortunate feature. So one of the things you need to be really careful of when you're looking at rate view rates is that rate view rates differ depending on the product. We will show different time horizons in the rate view rate. I think TE has a 15 or a 30-day rate. Don't quote me on that. Sorry, sales folks.
Trucker's Edge. Yep.
Yes, Trucker's Edge, about exactly what the time horizon is. But then the RateCast product, we tend to show 7-day rates for people who buy proprietary data. We have 1 and 3-day rates that are available. I think 3-day rates are in the product now. But like, make sure you're comparing apples to apples, and you're also comparing geographical apples to apples because of the escalation model in RateView, which we don't want to go too much into, or it will take literally hours of discussing.
I'm not sure that's the root of the question, Ned, because we have Miguel asked a similar question. I think what they're asking is, why are they seeing rates in the market being quoted that are different than the DAT rate? And that, I think, can be explained by, right, so we're reporting actual historical transactions, and then on RateCast, what we believe the history will roll in and look like. Just like anything else, right? It's a bid ask, right? So I think Amazon, last I checked, Amazon stock was trading around $3,500 a share. If you have a share and you're asking $4,000 for it, no one's going to buy it, right? If you have a share and you want to sell it for $3,000, it's going to get gobbled up really quickly, right? The stock market, just like the spot market for trucking, is just the kind of convergence of a bid and an ask, where you have someone willing to ship something for a price and someone willing to haul it for a price. They come together and they move. What you see in RateView is $100 billion worth of those consummated transactions. So I think the DAT tools are a great negotiating tool, but ultimately, like, that shipment's going to move for what the carrier and the broker or shipper agree to move it for on the spot market. No more, 100%. No less.
Yeah. And there, if you look at RateView, we do give a high and a low, and that's 50% of our rates fall between the high and the low, but that also means that 25% of observed submissions are above the high, and 25% of observed, credited, accepted submissions are below the low. So, and
we're working on that. So more to come. Ned and team have some really exciting things coming down the pike to help explain the entire curve, or at least a couple standard deviations worth of the curve.
Yes. I have a really good question for Todd, so I'm going to skip around a little bit in the ordering. ROI asks, what's the average revenue in terms of miles per week an owner-operator does? What's the average non-revenue miles as a % of total miles? Dean, Todd?
So our average driver is running about 101,000 miles per year right now. So you could translate that to like 1,950 miles a week they're driving. That would be total miles. You know, it varies widely. If I'm running real regional and I'm taking high-paying freight, I'm going to deadhead to get back to that. But I would say on average that you would see somewhere between 8 to 12% of those miles being non-paying miles. It could be as high as 25% if I'm hauling high-paying freight in a region, but those are some guidelines.
Has it ticked up during COVID, Todd?
You know, what you really see, you see drivers running less miles in times where rates are good because they get more choosy on their loads and they want to take more time off. So they'll deadhead a little more for a much higher paying rate. So yeah, you probably see more empty miles in today than you have previously.
We had a contractor who owned a few trucks when I was in the industry, and his unfortunate first name was Les, and we would call him Les Miles because that's all he ever complained about. I want to make more money and run less miles.
That's the dream. That's the dream.
That is the dream.
Jennifer Little asks, how do you expect the vaccine mandate to impact our industry for our drivers?
Dean, this has been a rate-heavy episode, so this is your time to shine.
Yeah, I mean, drivers social distance for a living, and the guys that I talk to, I don't know that it really affects them because they operate in a fairly small circle. the number of people they come in contact with is relatively low, and they've been encouraged not to have personal contact with people in the shipper community at docks. So I don't know that it'll have much impact at all, but that's on the smaller fleet side. Maybe, Todd, have you heard anything on your side from the guys you talked to?
I think he's asking about the mandate to get, will the fleets require them to get vaccinated?
Yeah.
So at the end of the day, truck drivers, I think, by and large, are more under-vaccinated than the population in general, by their nature and by the difficulty of just having to live their life. And so in the real world, if you take a fleet that has 100 trucks and they have this mandate, and so now either have to have the vaccine or we have to test you once a week, how am I going to test a driver over the road once a week? It's not realistic, and it's not going to happen. And I could take us into a political discussion, but
please don't.
I won't.
Get vaccinated.
It's not going to happen in trucking. There's no way to force the vaccine in trucking.
Well, so I remember, I don't even think they're going to have the option of those, because so federal workers don't have the option of the testing, and most of these trucking companies haul for DOD or GSA, which means they're going to be subject to all of the federal government flow downs. So like when the DOD went and GSA went to the FAR-based thing in California, when California said independent contractors have to have fringe breaks and all that stuff baked into their rate, those large carriers spent millions of dollars in legal fees and analysis to figure out how they would bake that in to ensure that what they were paying them matched what those fair labor standards would be. So I would have to imagine that any fleet hauling for the government on a contract basis is going to be subject to the hard vaccine requirement, not the testing alternative. I think
imagine that's true. You're right, Ken, but you've dealt with truck drivers, and they're not the kind that are going to go get a shot when you tell them you got to go get a shot. Right. So in the end, we already have a shortage of capacity tremendously. So you take another 100,000 trucks off the road because they can't haul freight because they're not vaccinated, and something's going to backfire. So, I don't see this happening.
Honestly, and this is kind of a hot take, and I haven't had a time to percolate on it a lot, which makes it a hot take. This could be more impactful than Drug and Alcohol Clearinghouse or ELDs. If all of a sudden all contract drivers and all asset-based fleets have to have the vaccine, that could potentially take more people out than...
that's a real sharp shock. Yeah.
Which means it's not going to happen. We already have freight not on shelves because there's not enough truck drivers to haul it. So if you want to see a false way to tank an economy quickly, let's require every truck driver who doesn't want a vaccine to begin with to get a vaccine. It's not going to happen.
Yeah, it's a dangerous game of chicken. So... keeping the politics out of it, but it's going to be very, something to watch, because this system, as we've all talked about, can't really metabolize another major shock. And even if we lose 2 to 3% of the for-hire capacity in a blink, or even if it's sidelined while it's working its way through the course, that could have major ramifications heading into peak.
Right.
Yeah.
Because a lot of the big asset-based carriers will view this as a flow down from the government, and they won't want to jeopardize their government contracts, I would assume. But we'll see. All right, are we running out of time? Do we have any?
We have one final question, real quick, if people have time for it. Fresh Air Brown. Supplies for parts, are they hurting the market for drivers?
I can tell you that parts for trucks and the maintenance, issue in general is terrible for hauling freight. There's people that, need 1 day's worth of repairs that are taking 10 days to get that done because they can't get the parts, they can't get in the shop, and it's definitely hindering miles being run.
Yep, absolutely.
Yeah, like I said, it's permeating beyond just chips at this point. I've heard the what do you want to call it? The carbon metallic material that's used for brake pads and drum brakes or for cars, and I know that doesn't apply as much to the big trucks, but still, shortages up and down the supply chain are hampering things. So not a great situation heading into peak if you're really levered highly in the truckload market, which most shippers are. I'm thankful that I'm in software and not moving freight right now. And my heart goes out to all those that have to move freight over the next couple of months. All right. Anything else that we're missing, guys?
That's it for the questions. CSCMP next week?
CSCMP next week will be in Atlanta. I had to make the difficult decision just with kids in school. I will not be attending, but we will have a robust presence from DAT, I'm sure. So I hope that goes really, really well. And I'm sure I've been to CSCMP once, and it's always a great event.
Is McLeod going on right now? Or
McLeod is going on right now. Transplace has their big symposium. We have, what else is coming up? There's a TIA event in October that it used to be Technovations, and now it's called like 3PL Extend or something. I think we're speaking at that one. But yeah, a lot of interesting stuff. Some of it's virtual, some of it's in person, but we're generally around. We're at the McLeod conference. I saw a picture of the booth, and it was kind of shocking to see a trade show booth for the first time in 2 years. But it looked good. So stop by and see us if you're at McLeod.
Todd, do you have any shout outs?
Man, we've talked a little bit, but my shout out is always to the truck drivers that are getting the work done out there, especially during Driver Appreciation Week. They just always get it done despite the challenges. God bless them, and just be safe.
Yeah, I want to end on that. We would always throw a big bash for Truck Driver Appreciation. We'd have barbecue out and a band, and it was always great I had a CEO that was very focused. I mean, she actually would make her executive team go ride in a truck. She disguised herself as a truck driver and went and ran a cargo van for a week to see what the dispatch experience was like through our company as the CEO, right? So spent many a days sitting in a TA, buying folks lunch and just understanding what their day-to-days are. And I would encourage anyone who thinks drivers are overpaid to go to your local TA and go to the desk and buy a shower and walk in there and see just exactly what these folks are dealing with on a day in, day out basis, and then kind of come back and say that they're overpaid for the work that's done.
Exactly.
So again, all of that to say, we very much appreciate the truck drivers. They're customers of ours. They drive the economy, and we hope that they stay safe and sort of feel the appreciation from around the country this week, for sure. Yep. But I want to thank Todd as well for coming on. I'd love to have you on, even if it was quarterly, Todd, if you could spare the time. This has been great, and we get tons of questions that are right in your wheelhouse.
Yeah, man, I love it. It's good to be with you guys. So anytime you want me, I'll be there.
Thanks, Todd.
All right. Thanks. And with that, we will be... Don't threaten us with a good time. All right, so we'll be back next Tuesday. No service disruptions, no holidays, no vacations coming up. So we'll be full force next Tuesday at 10 a.m. Eastern, and we look forward to seeing you then. Bye, everyone.
Bye.
See you.